Hey everyone, James O'Reilly here from Northeast to give you your 2021 federal budget wrap up. There's heaps for us to get through, as there always is, so I'm going to jump straight in. Obviously, general advice disclaimer here. This is not specific advice. Please talk to a financial advisor if you want to understand how any of this might impact you. Now, I make a really concerted effort to ensure that these budgets come out first thing in the morning on budget morning. I like to ensure that that's something that our clients get straight into their inboxes immediately. Unfortunately, it didn't work out that way this year. We are dealing with a quite unwell, almost 1-year-old, and both my wife and I are pretty gassed trying to keep up. So apologies for this one hitting your inbox in the afternoon today instead of first thing. Let's jump straight into the budget itself. The standout thing, of course, is that regardless of how we look at this, we are still projected to have a walloping net debt position in 2024. Admittedly, it is a little bit better. Last year we projected it was going to be 996 billion. Now it's 966 billion. So that's obviously any move down toward neutral is better. Having said that, this budget, we still have a $161 billion deficit. And what that means, just to confirm, that net debt position is basically what the bank account balance is at any time. So the 161 billion deficit means that we're spending 161 billion, or it's projected we'll be spending it over the next 12 months. And that's going to contribute to us being 966 billion in debt, which is not much if you say it quickly, by the time that we get to 2024, which is pretty terrifying. We might talk more about that as we move on. Individuals, we're keeping the Lamington. The Lamington, or as it's known, the Lamington, it's the low and middle income tax offset, LMITO, and it does look a lot like it says Lamington. It's an offset that's available, as it says here, for anyone who's earning up to 37,000, and that really kicks in and it ramps up between 37,000 and 50,000. You get the maximum tax offset, which is $1,080, almost $1,100, between 48,000 and $90,000. And then after $90,000, it actually starts tapering down to the point where the offset disappears altogether at 126K. Now, offsets are very good because they just completely reduce your tax. So whatever your final tax position is, a $1,080 tax offset just wipes $1,080 off that tax position. If your refund was going to be $2,000, it's now $3,000. So it is very beneficial. I think this is a good scheme. I think it makes sense to keep this for the time being, although I do note that it is a pretty expensive scheme because so many people fall into the low and middle incomes. Continuing on with individuals, there are some pretty positive superannuation changes afoot. The first one is that superannuation has historically only been payable for employees whose salaries are above $450 a month. But this leaves out a lot of people that might be earning $300-400 a month, especially younger people. They might be at uni and working or one of those sorts of things. So now going forward, regardless of income, as an employer, you're going to have to pay the 9.5% on your employee's salary, irrespective of what they earn. So net good for employees, which is good. The First Home Super Saver scheme is previously we had a maximum withdrawal amount of $30,000. You still can only contribute, for those of you that know it well, you can still only contribute up to $15,000 per financial year. You can get a tax deduction on that contribution depending on your overall situation. But if you contributed twice to $15,000 amounts, you'd be capped out at $30K. They've boosted it up to $50K now, or $100K for a couple. So this does allow you to access your super in order to buy the first home. I would note though, there's a bit of clickbait going around in terms of it's titled, accessing your super to buy your first home. It's not, because these are voluntary contributions. So you're actually putting money into superannuation with the intent of pulling it out later to buy a first home. It's not just a case of scooping out those contributions that your employers have put in over the years. The super downsizer contribution. This is a cool strategy. Previously, if you're over age 65, you could, and you were to sell your property, depending on your super balance, you could actually contribute some of that money, some of the sold value of your property into your super fund without too great a consequence. Now, the problem was that only applied for people over 65. So if you're moving toward retirement and you're 62 and you decide to sell the property and downsize, the kids have moved out, you don't need the space anymore. Well, when you do that, the problem that we have is that you won't actually be able to use this downsizer contribution. So you can now if you're over age 60. This is a good scheme, it makes sense. And the last one, again, this is a good scheme. There's no work test for people aged 67 to 74 anymore, at least it's proposed that there will not be. Currently, if you're over age 67 and you want to contribute to super, whether either as a person, a tax deductible contribution or a non-tax deductible contribution, you are going to have to meet what's called the work test. You have to do 40 hours of work in any 30 consecutive day period over the year in order to qualify. So if you, in this case, from a work test perspective, because that's gone, that just means people under age 75 can freely contribute to super, obviously subject to the caps. So I think this is a good thing. There are more people contributing and wanting to contribute to super over age 67. So this is a good scheme. There's a change to the childcare subsidy. This one's it is a little bit confusing, but essentially for those of you who are receiving childcare subsidy, which is actually a lot of our clients in some capacity, what happens when your children go to childcare is that you get a percentage amount back of the childcare fees, and that percentage is dictated by how much income that you have. So if you're earning $100,000 as a family, then you'll have somewhere in the order of 80% or thereabouts, 75% of those childcare expenses rebated back to you. And the higher your income, the lower the rebate, to the point where anything over 350k of household income, there is no rebate. Now, what they had in the past was two things. The first one is they had a $10,000 maximum claim amount. So this meant that often people would eventually, they might start in July and they'd be rolling along, and then suddenly the cost of childcare would go up significantly. Why? Well, because you've hit your $10,000 limit, so you can't go past that. And that was applicable for people with as they approach the right side of this graph with higher incomes. So that's now disappearing. There is no $10,000 maximum claim amount. The percentages will stay the same always, which is a good scheme. The second part is that there is a 30% increased amount for the second child. And the thinking here is that, so for the first child, whatever the number is, if you're earning this magical 253,680 in your household, 50% would be rebated. For one child or two children or three children. What this means here is that now for the second child, 50% would actually go up to 80%. But confusingly, only for that second child. The first child, you'd still have the pure 50%. So there is absolutely no benefit unless you have two children that are 5 years and younger and both at childcare. Now, one of the really annoying things about this scheme is that it's being pushed back to commence on the 1st of July 2022. And that just seems really stupid to me. The whole point of this scheme is to encourage, it's supposed to encourage people, and particularly women, to get back in the workforce. I'm super pro that, but if that makes sense, then why does it need to get started on the 1st of July 2022? Josh Friedenberg was asked this question and he said, there are technical issues with regard to changing IT and computer systems. Come on, mate. Come on now. There must be. Tell me we can't fix that problem. It just puts a real sour note on what would otherwise be a reasonably good scheme. A family homes guarantee. This is a really, really cool scheme. The concept is that for single parents who have only a 2% deposit and incomes, like you have to be earning income obviously, and your income's below $125,000 excluding any child support that you receive, the government will actually step in to help you to buy a home. Now, there are going to be limits. In Victoria, the limit I expect is going to be $600,000. It doesn't have to be your first home. You could have, perhaps you've owned a property and then you've separated with your partner and now you might be renting or something along those lines. This could really, really help in order to put you in a home. I think that's a really cool scheme. It makes tons of sense to me. There's 10,000 guarantees to be made over a 4-year period. Having said that, there's a likelihood that might be bolstered up at some point in the future. In the past, a 2% deposit, this just wouldn't get you where you wanted to be. It wouldn't allow you to purchase that property. And unfortunately, as we've seen a number of times personally dealing with clients, and they say, well, we have cash from perhaps a settlement, like from a marital separation, but I can't use it because it's not enough for it. The deposit's not large enough, so I can't buy a house. And so unfortunately, as house prices get more and more expensive, that dream's getting further and further away. So I think this is a really cool scheme. If it's utilised well, it's going to make a really big difference and perhaps help a lot of people that were previously paying rent. It's going to turn them into homeowners paying mortgages, and I think that's net really good. The business loss carryback scheme has been retained. We talked about this last financial year. If you're posting financial losses as a business, but as a company, but previously you've posted gains, then you'll actually be able to claim essentially cash back on the losses that you've made. Not dollar for dollar, but you'll be able to sort of reverse it. If you pay tax, you'll be paying 30% or thereabouts. So when you make losses, you'll be able to get 30% back. It's quite clever. It's consistent with some schemes that are around the world. USA, UK, New Zealand, Japan all run this. And as it says, it's promoting profitable businesses, either staying afloat or spending a lot of money, having big outlays, perhaps on more staff, new systems and so on, where they know they're not going to make profit this year, but it's worth doing for the long run. Getting to the point here now, instant asset write-off. This has been extended. This already existed before. There's no limit on the amount or the asset that you can buy. You have to use it in the business, and the percentage of ownership is important. If you use it 1% in the business and 99% personally, it's going to be 1% deductible. But any business with turnover about 5 billion, we don't have many clients with businesses with turnover above 5 billion, unfortunately. So not that big a deal for this rule restriction for most people. And as it says, the asset has to be used or installed. I'm pretty sure this is going to be bumped up to 30 June 2023, but I've written down here, this one's a very, very grey one, and I can't stress enough how important it is to speak with your accountant before you go out and do these ones with your business credit card. Other winners. Aged care sector is going to be beefed up. This is long overdue. This scheme, this particular proposal, just makes a lot of sense, and particularly for anyone that's followed the Royal Commission in aged care, which was horrifying. 1.1 billion invested in women's safety. This is going to be really supportive of. It's going to provide support around domestic violence, but also there's inside this some initiatives around medical research for women's conditions like endometriosis and other things that really need more focus. We have some wage subsidies, 2.7 billion for trainees and apprentices, and that's separate to a job trainer program, which is actually subsidising the study costs at TAFE and other vocational training. So definitely a good budget for trainees and apprentices. And we've got quite a few clients in this boat. For employee share scheme holders, whether that's ESS or RSUs, in the past, if you left your company, in a lot of cases, that would result in all of your options vesting. And if all of them vest at the same time, for anyone that we're working with will know, almost always, that's going to create this horrendously ugly tax liability that can be hundreds of thousands of dollars depending on the success of your employer share scheme. So the benefit here is that that's no longer going to be mandatory that they vest at that point, or from a tax perspective, the tax can be deferred to another point, which potentially stops just the forced sale of all of those assets in order to look after the tax when you leave the company. For those of you that are affected here, we'll have a chat about this shortly. There are some losers here. The environment is a loser, and this is an obvious one, but considering all of the spending, considering that we're in a big deficit again, I really hope that there'd be more here. The rhetoric around it is that there's, hopefully we'll get back to sort of neutral by 2050. I personally think the government's they're just behind the times here. They're behind what the wants of most Australians here, and I think this is I just feel like we've missed the mark here. No super paid on paid parental leave. There was a lot of speculation that women who are on paid maternity leave would be able to receive a 9.5% payment on that paid maternity leave payment, which is not a huge amount, but it's just enough to ensure that super is continuing to be contributed to during that time. Silence on that one, which means that it ain't happening. People with wanderlust, myself included, if you're feeling trapped and want to get out and do some travel, it seems pretty apparent at a federal level that that's not going to happen in 2021. It's not really much of a surprise, but it just hurts having someone confirm it. So realistically, save all your plans for mid 2022 at a minimum. and also foreign aid is reducing by 10%. It makes sense, in like you obviously look after your own house first. So a poor outcome for our neighbours, but also perhaps the right decision. Summary. I've always previously provided impartial presentations and not really given a view on how it's all unfolded, but at the request of a couple of clients, here it is. Feel free to turn off if you don't want to listen to this bit. I feel pretty disappointed with this budget, bluntly. I think that there was a lot of fiscal responsibility needed here. We've really seen things start to fire off again, and we've seen the economy start to move. There's a lot of things that are really promising, and I don't necessarily think the right play here was to tip more fuel on the fire, because of course there's a significant cost. All the while, as the more that we spend, the further and further away we are getting from a net debt neutral position. We're so reliant. If we're at 2024 and still, even after this economic recovery, we've still got $1 trillion of debt. Geez, we're reliant on interest rates staying low. Like if global interest rates, if we see a period of inflation, a meaningful period of inflation, that is going to have a horrific impact on Australia and obviously a lot of nations. So that's a genuine and legitimate concern in terms of how Australia will fare in the coming years. This smacks of an election budget to me. It very much seems like there's this spending big, ironing out as many of the kinks as possible, as many things that their biggest detractors are critical of before calling an election. I'd be amazed if we see another budget before the next election rolls through. So it's very common for governments in power to spend more money when it comes to pre-election budgets. They want as many people to be happy as possible. But again, I think there was something bigger at play here, and spending a lot of money in this particular budget in order to please people, I don't actually think was best for our country as a whole. It's certainly not best for our country in 10 years' time. Credit where credit's due. There was big spending in the last budget, and that big spending, they said, look, this big spending is going to turn this country around. It's going to turn things around economically. And to their credit, it has. They are, they're sticking to something that they tried before and it worked. I guess from my perspective, I think that we've had some wins as a result of that, and I think that right now it's a time to either be taking some chips off the table, or at least not just pouring more chips onto the table right now. We'd say, all right, we're in front now compared to how things were previously. Like where things are looking a lot more optimistic, and given that we don't necessarily need to keep betting heavy. We can start to slow it down a little bit and just see how the economy moves on. They're probably the things that predominantly stand out to me. Obviously, if for all of you out there that are clients, we'll be in touch to talk about how this might impact you, if there's anything that stands out in particular. And then equally from your end, it goes without saying, if you wish to chat at all, feel free to hit me up personally. For those of you that are not clients, if you want to learn more about the budget or how this might impact your financial situation, then feel free to click here and we'll give you any clarity that you need. Thank you, everyone. Very grateful for your time, and chat to you soon.